Welcome back to another stock analysis, where I look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze Johnson & Johnson, which is one of the biggest companies in the healthcare sector. Last, they generated a revenue of $94 billion and they have a market capitalization of $454 billion. The income of Johnson & Johnson is generated through three main segments, which are pharmaceutical, medical devices, and consumer health. The pharmaceutical segment consists mainly of immunology, infectious diseases, and neuroscience. The medical devices segment consists of surgery, orthopedics, and vision. The consumer health segment consists of skincare, oral care, baby care, and more. Regarding the geographically diversification of the company, it is informed that 50% of the revenue is made in the US, 25% is made in Europe, 18% is made in Asia Pacific and Africa, and 6% is made in the Western Hemisphere, excluding the US. The different segments of the revenue can be divided even further, but to keep the video simple, I choose not to. If you want to look further into the revenue, you can check out the annual report of Johnson & Johnson, which I have linked down below. Enough about the introduction. Let's find out if Johnson & Johnson is a good stock to buy at its current value. The key matrix I use to calculate the fair value and buy price of Johnson & Johnson is the dividend yield. I'll start with plotting the dividend yield for the last few years in a historical chart. I choose the dividend yield because a consistent dividend politic, for me, is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio and it makes it easier to rebalance my positions. To create some sort of signal line, I take the 5 years moving average of the dividend yield and plot it in the chart. The simple approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 2.58%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. In an ideal case, the curve will give a straight line. I can measure how much the curve deviates from this ideal straight line by calculating the relative standard deviation, which for Johnson & Johnson is 8.7%. To the historical yield, I add a personal defined margin of safety of 25%. This margin of safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. With this value I can measure how volatile the dividend yield is. A high relative standard deviation will higher my risk to invest at a bad timing. As said earlier, the relative standard deviation for Johnson & Johnson is 8.7%. This value is inside the yellow section of a weighting scale. Therefore, the margin of safety doesn't change. As a dividend investor, the dividend growth, of course, is a very important matrix for me. In 2007, $1.62 were paid, and in 2022, $4.46 is expected. Johnson & Johnson has paid and increased the dividend for 60 consecutive years, which makes them a dividend king. In the last 5 years, the average dividend growth was 6.1%. A dividend growth of 6.1% is once again in the yellow section of the weighting scale, and therefore the margin of safety doesn't change. By looking at the payout ratio, I'll find out if this dividend growth is sustainable for the company. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. The free cash flow from Johnson & Johnson has increased from $18.5 billion in 2018 to $19.8 billion in 2021. The cash dividend were respectively $9.7 billion and $11.2 billion. The average payout ratio thereby becomes 54%. This value is in the middle of my weighting scale. Therefore, the margin of safety doesn't change. Next, I'll take a look at the debt situation. The company has a debt of $2.1 billion and has $31 billion in cash. When the cash gets subtracted from the debt and this value then gets divided by the EBITDA, the debt to equity ratio is found. The EBITDA is currently at $36 billion. Since the company has more available cash than debt, the debt to equity ratio becomes zero automatically. The debt to equity ratio tells us that the company could pay off the whole debt at any time if they wanted to. This is of course a very good value, and for this matrix I'll subtract 5% from the margin of safety. The next thing I'm looking at is the growth of the company. The revenue has increased from $76 billion in 2017 to $94 billion in 2021. This gives an average growth of 5.2%. In the same period of time, the EBIT increased from $19 billion to $29 billion, which gives an average growth of 11.2%. The margin is found by dividing the EBIT with the revenue, which in 2017 gives 25% and in 2021 increased to 31.2%. Since the EBIT increases at a higher rate than the revenue, it only makes sense that the profitability of the company increases. In this case, it increases with 5.7% in average. An EBIT growth of 11.2% is in the dark green section of my weighting scale, which gives minus 10%. An average margin increasement of 5.7% gives minus 5% to the margin of safety. In this video I would like to introduce a new matrix, which is the potential yield on cost. This matrix tells which company has the best future potential. Johnson & Johnson has a dividend yield of 2.58% and a dividend growth rate of 6.1%. I assume that the dividend gets fully reinvested at the same conditions. But I'll subtract 15% from every dividend payment, since they have 15% withholding taxes from stocks from the US. After 5 years, the yield on cost would be 4.1%. After 10 years, the yield on cost would be 6.46%, and after 15 years, the yield on cost would be 11.7%. A yield on cost of 11.7% after 15 years isn't that great, so I'll add 5% to the margin of safety for the potential yield on cost. Since every matrix for my analysis has now been collected, it is time to adjust the margin of safety. Minus 5% for the debt, minus 10% for the EBIT growth, minus 5% for the margin growth, and plus 5% for the potential yield on cost. The new margin of safety is therefore minus 10%. This leads to a desired dividend yield of 2.9%. By a current dividend of $4.46, I should therefore don't pay more than $154 for the stock. By ignoring the margin of safety, the fair price of the stock is determined, which for Johnson & Johnson is $169. These values can also be shown graphically in the chart for the historical dividend yield.